Okay, good morning and good afternoon, depending on where you are in the country. Thank you for joining me today. I'm Greg Yotis. I'm the Senior Sales Director here at Pinnacle for Life and Annuity Products. Today, we are going to be covering how we here at Pinnacle make selling annuities as easy as possible for you. Whether you're just getting into annuities or are seasoned with annuities, we want to make it as easy as possible. And we're going to go through kind of those things as far as the products we offer, how to quote and illustrate the annuities, any licensing requirements or how to get licensed with the annuity carriers, and just talk a little bit about why it makes sense to introduce the annuity sales into your practice if you haven't already, or how to even increase your annuity sales. So with that, we're going to get started. As always, if there's any questions, feel free to either type that into the chat or the questions section of the webinar, and we'll answer those at the end of the call. So first, just want to introduce you to our team here that we have on the life and annuity side. First, just want to introduce Mark Bolger, our agent care specialist, and then there's myself, Greg Yoda, Senior Sales Director. So our numbers are there and emails. Also want to introduce Bill Vandergrift, who's our new business administrator, who can help you with all of the business that you submit to us and making sure you're staying on top of that. So, feel free to reach out to us. You can also send an email to lifesales@pfsinsurance.com. We're here to help you every step of the way. So, with that, I just want to first kind of set the stage for annuities and kind of what we're looking at in today's environment. So, this just is a kind of a common sense idea, but, Americans are living longer these days, as we all know. So retirement planning is even more essential, right? So challenges that they're going to face during the retirement years, making sure that you don't outlive your life savings or your retirement savings. Annuities are going to be able to provide you that protection where there's no way that you can outlive that, especially with the living or the income riders that you have on fixed indexed annuities. But I'd also say, and we'll look at the different products, but with the volatility in the market that we've experienced recently and over the years, annuities are a great way to kind of give yourself downside protection while your clients are still having upside potential and not really worry about the ups and downs of the market, right? So it really gives you a peace of mind, gives your clients a peace of mind that they're doing the right thing and they're not going to lose money. So with that, how many people are potential clients for annuities? And this just kind of highlights, why you should be talking about it and making sure that you talk about it with your clients. 95 of the retirement savers out there agree that having some sort of financial plan, and I say that not even as a full-blown financial plan, but just having an idea of what you're trying to accomplish. 95% of the people out there that are, which I'd round that up to almost everyone, is concerned about retirement savings. 81% of the retirement savers out there are concerned about having enough money to last them in retirement, right? Everyone wants to have a comfortable retirement. They want to make sure that their money's going to last no matter how long they live. And also, it's a great way for legacy planning and making sure that there's money there to give to your heirs after you pass. So 81% of people are concerned about that. And then 54%, say that they are considering some sort of lifetime income. When you talk about lifetime income, those who maybe didn't do a great job of saving for retirement, they're not going to be able to rely on Social Security, right? Social Security is really designed to keep the lights on, have some money in there. But if you want to have a comfortable retirement and not stress about, the affordability of things, having some sort of other guaranteed lifetime income is very important and really goes a long way to giving people the retirement that they want. So here at Pinnacle, the types of annuities that we offer, and we're going to go through each one of these and kind of explain the ins and outs so you can understand them. But we have the SPIAs, which stands for Single Premium Immediate Annuity. We have MIGAs, which are multi-year guaranteed annuities. And then we have the fixed indexed annuities where we'll take a look at some of the riders you can add on there. But let's just dive into each type of product, right? So the SPIAs, that's going to be a single premium purchase, one-time payment. You're basically turning that money over to the insurance provider, and they're going to give you a string of payments. Now, those can be over a specific time period, whether it's 5, 10, 15, 20 years. And there's a lot of different options as why you'd want to do that. But it lets you kind of tailor that, and then you can have lifetime payments. So it's really a great way to make sure that you have that continual income coming in for whatever time period you're looking for or trying to solve, and maximizing kind of the returns that you would get with no risk of losing money. So very, very similar to, say, a pension or how Social Security works. You have a lump sum of money and you're going to get paid out. So with the SPIAs, the advantages of those, very easy to understand. It's, single premium, and they're basically saying, hey, for that premium, we're going to give you some interest and pay you out a either monthly or annual income over a specific time period. Like I said, either 5, 10, 15, 20 years or lifetime. So those guaranteed payments are guaranteed for the life or the term of the SPIA. Those payments don't fluctuate. They're going to be the same consistently, month over month or year over year. Higher, the older you are, the higher the payout's going to be. So you get some mortality credits for being older, because they don't have to pay out the benefit for as long the older you are. Low fees. There's really no fees. Everything's baked into the product, and it does offer some inflation protection because you're getting that interest on top of the money that you put in there. So as long as that's outpacing inflation, you're ahead of the game there. So as always, if there's advantages, there's disadvantages. So some disadvantages for the SPIA: lower liquidity. Once you make that single premium payment into the single premium immediate annuity, you lose control of that underlying cash value. The only thing you're entitled to going forward is going to be those income payments that you're going to receive. So, we put on there large upfront costs. Like I said, everything's baked into the product. There's no additional fees, but that it's part of the product. There are, as we said, inflation risk. The only time that it's really inflation risk is if your returns based on interest rates that you're getting is lower than what the inflation number is. So right now it's we're ahead of the game where interest rates are and where inflation stands today. So that's not a risk right now. And then also smaller inheritance, because you're using that fixed amount to generate income. So if you basically live past whatever time frame you're having those income payments come out for, there's no money to turn over to your beneficiaries. That money is exhausted. You've received that income payments, and there's no money to pass on to your heirs. So that's SPIA. Some of the more common things that SPIAs are used for, just to give you an idea of when you're talking to clients. SPIAs, if somebody has a lump sum of money that they say, hey, I want to generate an income. A lot of times what we see, people maybe in the beginning stages of retirement say, hey, I want to enjoy my retirement in the beginning years. I'll probably slow down as I go on. So maybe they want that extra income for the first 10 years of the retirement. Sometimes people use the SPIAs to fund a life insurance policy. If you're kind of, paying that over a specific time period, say a 10 or, 5, 10, 15 years into a life policy, they're using that lump sum of money to then pay into a life insurance policy. And in a lot of cases too, it may just be for extra income. They have money sitting around. They say, hey, if I can generate an income from this and just increase the income I have in my retirement, it makes a lot of sense with no risk. So the next type of product that we offer, which is very popular, is our multi-year guaranteed annuity, which is a type of fixed annuity. Basically, at the end of the day, just to make it easy for you, you get a fixed rate So it's really a CD alternative. Works very similar to a CD where you put in a specific amount of money, and they're going to guarantee you for whatever the guarantee period is, whether it's 3 years, 5 years, 7 years. You can actually go all the way up to 20 years. They're going to pay you a specific percentage each year guaranteed. So, for instance, if you did a 5-year MIGA, multi-year guaranteed annuity, they may pay you 5% each year for those 5 years. And then at that point, at the end of the guarantee period, you can either move that to another annuity, take your money out, pay the taxes on, any of the interest that you've taken, or you can actually roll that and do a 1035 into another annuity based on where the interest rates are at that date. So gives you some flexibility. People really use this for their very conservative money, where they don't want to lose anything. They want some guarantees. They're not so concerned about having really high upside, and they just want to make sure that the money's there, and they're earning a decent interest rate to keep ahead of inflation. So the MIGAs are very popular. Rates are still really good. Like I said, it's right around 5% right now for most 5-year multi-year guaranteed annuities. A lot of times where you see clients that would want to utilize this is, if they have money sitting in a checking account and they want to get a better return, and they know they don't have to touch it. If they have old CDs, or if they have old annuities that don't have as good of interest rates, those are opportunities to 1035 those annuities into a new multi-year guaranteed annuity with a better interest rate and better return. So pretty straightforward there, very easy to understand, no costs. There's just, there's surrender charges just like you would have with a CD at the bank. So if you take your money out early, it may hit you with some surrender charges to take the money out early. And there's also some, different options as far as the withdrawals. Some have no withdrawal, free withdrawals. There's others that have a 10% free out, so if you do need to dip into the money. And then there's some that have interest only, so you can take out if you receive 5%. They'll let you take out that 5% without any surrender penalty. So it's really important to talk to your client and make sure that they understand if they're going to have to access this money unexpectedly, that there may be some surrender charges. But that's a conversation you'd have with them. I always say, the benefit of maybe having either interest only or no free withdrawals, you get a little bit higher of a rate, but that's a conversation to have with the client. If it's worth it, I always say it's generally better to have the 10% free out, maybe take a little bit less of an interest rate return, so you have that flexibility, because as we all know, life happens, and if you have to dip into that money, you don't want to get hit with any surrender penalties. So just keep that in mind for the MIGAs. As always, advantages for the MIGAs, tax deferral. Like I said, as you receive the interest rate, as long as it's inside of and you're not taking any money out of the annuity, you're not going to pay any taxes. Not until you actually take the money out of the annuity would you be responsible for any of the interest it's gained, as far as taxes. And all annuities are taxed the same way, just, first in, last out. So, they say whatever you put in initially, that's your cost basis. Any interest you earn on top of that would be your taxable portion when you pull it out of the annuity. So great for tax deferral, great for principal and interest protection. Like I said, guaranteed products, no downside risk. Flexibility, like I said, you can ladder these. If you want to do a few different years. You can do a 3-year, a 5-year, and 7-year. They're all mature at different times, so you're capitalizing on the changes in the interest rates to get, those rates as high as possible over time. Flexibility to move it out of, once the guarantee period's done. Low investment minimums. Some of the MIGAs go as low as $5,000, so you don't need a ton to be able to put in there, but it makes sense, like I said, for any of the principal protection or safe money that you want, but you still want to get a return. And a lot of people use it too for beneficiary protection. They put money on the sidelines. They don't want to lose it. They want to make sure it's there for their heirs, for their kids, when the time comes. So disadvantages for some of those, a little bit less opportunity for growth, compared to either a variable annuity or something that's a variable like a mutual fund. You have some higher upside potential because, depending on what the market's doing or the mutual fund, you can have some higher growth, but you don't have those guarantees. So it's a trade-off there. Inconsistency in the rates. So, the rates are based off of where interest rates are. So, it's a little bit more inconsistent when it comes to the shorter time periods. For example, if you did a 3-year today and you were getting somewhere around 4.75% each year, 3 years from now, we don't know where the interest rates are going to be. So you may actually, the next time to re-up that guarantee period, you may be looking at something closer to 4%. But again, the inconsistency because depends on where interest rates are. And of course, if inflation rises and interest rates go down, you do have some inflation risk there. So, the rate of return you're getting may not be keeping pace with inflation. So there's some risk there. But like I said, at the end of the day, it's really good for somebody who's conservative, wants those guarantees, doesn't want to lose any money, and are okay with, the 5%, say, for a 5-year guaranteed rate, 5% each year. So maybe not all of your money, but a portion of your money definitely makes sense to put in there. And then finally, we have our fixed indexed annuities, which are probably our most popular. And those basically, they're going to be able to provide you, along with the upside potential that you have with your money being invested in different index segments, and we'll talk about those different index segments. But the performance is going to be based on the index. So most common one I'll use. There's a lot of them out there, custom indexes, regular indexes, but the S&P 500, most people know that. So your performance of your market of your cash value is going to be based on the performance of that S&P 500 index. So but you also have that downside protection. So gives you kind of a little bit of best of both worlds. You don't have unlimited upside, but you do have upside as far as how the index does, but it's still giving you that downside protection, so you're not going to lose any money. So really good option for people who are trying to do that, especially I'd say, people who are getting close to retirement or in the beginning stages of retirement. Very, very good option. And I'd say right now, based on the market fluctuations, any of you who have 401ks probably see, or clients who have 401ks see the amount of fluctuation that's going on in their cash value and their market performance. So it's really important to kind of protect that at this stage, right before you're ready to retire, beginning stages of retirement. So it's very tough to make that up. So advantages of the fixed index annuities, you're going to limit your losses. Like I said, that downside protection, which is huge, possible guarantees for your earnings. So, you can lock in. Each fixed indexed annuity does have a fixed bucket, which kind of works on an annual basis where they're going to give you, say, 4% interest. So you have the option to use that to get some guaranteed earnings. It's going to give you inflation protection, because in most cases, the index, when they go up, they're going to outpace inflation, so your money's staying ahead of that, and you're not losing anything to inflation. And then the tax deferral growth, like I said, for those people who are concerned about taxes, you can put it in the annuity and you don't owe any taxes until the money comes out, and you only pay taxes on the gains. Excuse me. Disadvantages of the fixed index, if you compare that against the variable product, there are some limitations on the upside potential. So, that's a downside. But like I said, you're not getting that downside risk that you protection that you get with these, that you do with the other variable products, because there's unlimited downside to that. So it's a trade-off. there are some fees involved besides the normal um, surrender schedules that, based on if it's a 5-year, 10-year surrender schedule, and if you need to take that money out early. But like I said, all of the fixed index annuities are going to have a 10% free out. So you can always access 10% of your money if you need to dip into it. Anything above that in a given year, then you'd be hit with those surrender charges. So people need to understand that these are long-term investments, and they should be expecting to keep the money in there for however long that surrender schedule is on that product. And when you say surrender schedules, I mean, just think of it this way. Most of them are pretty similar. But, the longer you have a surrender schedule, generally the higher caps and rates that you're going to get because your money is tied up with the carrier longer. The shorter the surrender period, the little bit lower of a return you may receive because you don't need to keep it there for as long. There's some uncertainty with returns, of course, because now your cash value is locked in with the performance of the index, and this will make more sense when I kind of go through the different index segments. But there's, you're not guaranteed a specific rate of return. So when we talk about the fixed indexed annuity index segments, these are just some of the key terms that you'll hear. A lot of times some of these terms can be interchangeable, or there may be different names from, but mostly the most common ones, if you hear a loss floor or a floor, that's just saying that it's the worst you can get as a return is a 0% return. So that's the downside risk that we talk about. If there's any kind of minimum returns, there's some that may offer, say, a 2% minimum return on the rate of return, or like I said, there's the fixed bucket that you can put the money in to get a guaranteed rate of return. But there's some that out there, not many offer the minimum returns. Adjusted value just means that they're going to use a method to kind of project what the return's going to be based on the performance of the index. We don't see those too often, but they are out there. The two most common that you see, maybe three most common that you see, you'll see the return cap, or generally just called the cap. Think of that as if the cap is set at 10% on the S&P 500, if the index does anywhere between 0 and 10%, your return's going to be that return. So if it did 8%, you're going to receive 8%. If it did 2%, you'll receive 2%. But if the index actually outpaces the cap and you get maybe a 15% return that year on the S&P 500, they're going to cap the return at 10%. So like we said before, that goes back to kind of the not having unlimited upside. You're kind of capped on the upside based on where those caps are. And most caps are all based on where the interest rates are as well. So across the board, not that they're all the same, of course, but most of the caps are somewhere in the same vicinity based on the surrender period. And then the participation rate is another good option. Generally what that is just saying that if you're going to participate in the index based on whatever that participation rate is. So just to use easy numbers, if the participation rate is set at 50% and the index does 10%, the client would receive 5%, right? 50% of the return. If the index does 20%, and your participation rate is at 50%, you're going to receive 10% return. So it gives you a little bit higher upside potential, basically in more bullish markets, and the index are doing well, because you can, you're going to have a percentage participation rate. And I use 50% just to make it easy, but in most cases, some of those participation rates can even be higher than 100%. We've seen them as high as 200%. So depending on the index, you can use those participation rates if you really want to capitalize on upside potential, but you still have the 0% floor. And then the spread margin, asset fee. Basically, what that would look like is if there's a fee for the index to get a little bit higher of an upside, that is actually taken out, and then you get the higher return. Margin and spread, kind of the same thing. Just to use easy numbers, if it's 10% return and there's a 1% spread or margin, then you would receive 9%. They're going to take that 1% spread or margin off of the return of the index. So pretty straightforward. Like I said, the most common ones, though, that you'll see are the caps and the participation rate. So fixed index annuity, basically when you're ready to start taking out that money, you can convert that into a stream of income by using a lifetime income rider. And this is where you really kind of turn the money into, like I call it, a personal pension. So you can get that string of payments for the rest of your life, and you can't outlive it. The average cost of a lifetime income rider is 1%, but it's well worth it because you get what you pay for, and you're never going to outlive that income that you're generating. And then with those income riders, there are some options there to get bonuses and different things to really increase the income based on the money that you put into the annuity. So there's a lot of different options. Won't go too much into that because it gets a little technical, but just to let you know, that's why we make it easy here. We are here, myself, Mark, Bill, to make it as easy as possible to answer any questions you have. We'll do the research for you. You just need to come to us with the case, by talking to your clients, asking them what they're doing for retirement, what type of assets they have. The easiest one to do is ask if they have a 401k, and if they want to protect it on the downside but still upside, or turn that into a lifetime income. But bring us the scenario, and we can do a lot of the research for you, and give you the presentations and the illustrations that you can then present to your client. So with that, I'm going to start and take you a look at our website here, so we can see what we offer to help you with the annuity sales. So if you're not familiar with our website is www.pfsinsurance.com. And when you go in there, if you're already appointed with us, you have access. If you're going to get appointed with us, we will grant you access to it. And we have quoting tools here. And you can simply go to quoting and down to annuities. Once you do that, you have access to Annuity Rate Watch. And just to take you through a few things here quickly, without spending a whole training on it, you could search for MIGAs. So for instance, and I'll just do it quickly here. But say, for instance, we were looking for a 5-year MIGA in the state of Pennsylvania, and the person had $50,000 to put in there. You can simply hit search, and it's going to tell you the various annuity products. And we don't have access to all of these. I forgot to mention when we talked about the products, we do offer a little over 20 different annuity carriers with various annuity products. So we have a solution for whatever you're trying to solve. But just wanted to quickly show you how you can look at the rates and see. So just to quickly go through, they're going to tell you if the carrier, what their AM Best rating is, their maximum issue age, the minimum that it needs. Like I said, some of them are 25, some of them are 5, some of them are 10. And then when we talked about the free withdrawals, you see you have a variety of them. The 0% is no withdrawal. So the interest is interest only, and then you have ones that have a 10% free withdrawal as well. So they'll tell you what the current rate is, what the base rate is. Generally, they're going to be the same. If they're giving you some kind of bonus in the first year on the rate, you'll see that the most important thing is this guaranteed yield to surrender. Tells you exactly what it is. So as you can see here, for the 5-year, you can get as high as 5.5%, which is a really good guaranteed rate of return for 5 years. So And then also you could search for the fixed indexed annuities, basically doing the same thing. So for instance, you see there's all different types of surrender products. They're going to kind of give you what their base rate is on the fixed side. Some of them are pretty higher for the longer term ones. You have the free withdrawal scenario again, how long the surrender schedule lasts, and if there's any additional riders when we talk about the income riders and those things. So pretty simple. We can always, take some time and do a training. We have some recorded trainings out there on how to actually search for the annuities in here and do that research. We could do it for you, but that's pretty much what we look at. And then also, another thing we have here to make it easy for you, first you can always go to forms, and you can go ahead and if you need an actual paper contract, you can actually go through here simply by choosing the states, and the type, and then the product, and you can pull actual paper applications right from our form section, and then either email that to yourself or print those out, and so you have the most up-to-date application. But if you wanted to do a e-application, we do have our own version of Firelight, which is a e-submission annuity tool, and you can simply go into online enrollments and then down to Firelight Annuities. And when you go ahead and click that, if you've never used it before, there's a one-time setup to be able to have access to it, just by putting in some simple information as far as your username or your name, email address, and password. But once you go into the system and you have access, you can do all of these annuity carriers, which is about 90% of the annuities we offer. You could do straight through the system here a electronic e-application. You could see there's a variety of carriers that you can, a whole list of different carriers you can offer, but you could pick the carrier and then pick the product that you want, and then simply complete the e-application. And what that'll do is go ahead and you could fill that in electronically, send that to the client. It'll go out as an email. They DocuSign, and then you as the agent would receive an email as well. Then you DocuSign it, and that goes automatically once the signatures are completed electronically, goes automatically to the carrier, and the carrier then processes it. So really cuts down on not in good order. I will say, those of you who have done annuity applications are aware of this, but they're pretty long and involved. A lot of areas that you can maybe miss or those type of things. So the e-application really cuts down on missing information and that kind of stuff. And it definitely speeds up the time as far as getting the application in, and also getting paid if the case is getting approved quicker than a paper application. So really easy to use. Again, we can always set up time to kind of walk you through that and do a training. We do have recorded trainings out there already on our website that you can utilize. And then finally, just going back to some other details that you need to be aware of as far as getting appointed and completing any kind of carrier-specific training. So on the annuity side, to be able to offer the annuities, couple things you need to have in place. All states have a annuity best interest training, which is a 4-hour training that you need to complete that at least one time, and it covers your best interest training for your appointments. And then the only other thing you would really need would be your updated AML, and we can get you appointed. If you're life licensed through your state, that means you're available or able to sell fixed annuities. It comes with that license, so there's no additional special license you need to get. Excuse me. And then finally, each carrier is going to have their own carrier-specific training. So depending on the product that you're selling, there'll be a carrier-specific training that you need to complete. Those are very simple, very quick to do, but it's really just there. You're required to kind of know the product that you're selling, or at least know um, a decent amount of what you're doing. So those product trainings, they all needs to be completed before you can get appointed with the carrier. You could just request those appointments through myself or Mark, or through our website in our contracting section, and then our licensing department will send that contracting out to the carrier and get you appointed. Most annuities, I'd say 98% of them are all, pre-appointments by the state, and so you need to be appointed and your product training done before you can submit any annuity applications. So sometimes we have people write applications before they're appointed, and then they got to go back and redo the application with a date that's after the appointment. So just make sure that you talk to us, make sure everything's in order before you go ahead and submit that. As far as going back to the quotes, if you needed us to run you an illustration, we can do that. The only information we would need to do it is really the person's state, their date of birth, and how much they're putting in and what their goal is, and we can run those illustrations for you. We would have to run that. That has to come from the carrier's website. As you get appointed with any of the annuity carriers, you'll have your own access to their website, so you can actually run illustrations yourself, but we can help you with those. I do say, even if you don't want to do it yourself, you should at least give it a try, because I really think that running illustrations really helps you understand how the annuities work. They're all fairly similar in how they work. So if you're able to run illustrations and understand those, then it really goes a long way to understanding the annuity process and the annuity products. So with that, just again, please reach out to myself or Mark. We're here to help you every step of the way. We joke around. We're here to help you from submission to commission. We help you with sales ideas, case design, anything you need as far as doing the annuities, and we're always available. Also, if you're looking for leads for annuities, you can always contact us. We have a variety of third-party lead vendors that we utilize, and you can actually purchase those annuity leads through those vendors to help get that business jump started and going. So feel free to reach out. We make it as easy as possible. We're here to answer any questions. I'm going to go ahead. Looks like we have quite a few questions that came in, so I'm going to go through and answer these for everyone. So we have a question here as far as what are the typical commissions paid? Great question. Typically, what you would see, it depends on each carrier and their commission schedule. But on the fixed indexed annuities, generally you're going to be somewhere between 5 and 7% of the premium amount. So easy math. If you put in $100,000 into the fixed annuity and it's paying a 6% commission, you'll receive a check for $6,000. All commissions are paid directly from the carriers, and we don't take any kind of haircut or anything like that. So you get that full 6% based on whatever the commission schedule is for that particular carrier. That's on the fixed index annuity. On the MYGAs, what you could expect, because those are guaranteed products, and with that being said, you can see why it would be a little bit lower on the comp, but generally you're going to be between somewhere about 1.5% or 2%. So if you put $100,000 in there and it's a 2% commission, you're going to receive a $2,000 check for that MYGA. So hopefully that answers your question, and we're always here to kind of talk you through that. And next question is, so next question looks like as far as avoiding IRMA and the impact on Medicare benefits, moving a 401k to an annuity. For that, There's limited options. The 401k moving to an annuity would have no impact on your IRMA. Now, you may be able to avoid some IRMA situations if you use a SPIA, because you're actually giving up that underlining asset for those future string of payments. So your overall net worth would look less. So that would be an option. And there are carriers that have Medicare approved SPIA products that you can do. And generally on those SPIA products, you'd have to do lower income periods as far as like 5 or 10 years. Next question in here. PNC brokers cannot sell annuities, correct? That's not always the case. It depends on the license you have with your state. So if you have your life license through your state, regardless if you're PNC or not, you could sell annuities. But if you only have a PNC license, you would not be able to sell annuities. You have to have that life license through your state to be able to sell the annuities. Next question, what is the asset fee? Excuse me. So I'm going to take that question as there could be a couple different ways that you say asset fee. In some cases on the indexed annuities, when you have a fee on the index segment, generally those are going to be somewhere around 1%, and that allows you to get a little bit higher of a cap. So what you would see is, say for instance, you have an annuity, fixed index annuity product that has a 10% cap with no fee, and then they may offer a performance fee or an asset fee where the cap actually jumps up to 13 or 14%. And they're going to charge you 1%. So makes a lot of sense for if you're bullish on the markets and the markets are up, because you can get a little bit higher of a return based on that cap being higher, but you are paying for it. I can say this, I'm not a huge fan of using the products or using the asset fee or performance fee in the products. And the reason why is you have to pay that fee regardless if the market's up or down. So it may work in your favor when the market is up, because you're getting a little bit higher of a cap or participation rate for that fee, and it translates into higher growth. But when the markets are down, you're still paying that fee. So now your 0% floor is really more like a negative 1% because you're paying for that fee. So not a huge fan of that. There's very far and few between situations where I would say, use the performance fee or the asset fee. But across the board, if you're asking about just fees, there are no fees on these annuities other than the surrender schedule. So if you take the money out during that surrender schedule period, so if it's a 5-year surrender and you take the money out, more than the 10% in year 4, you're going to pay whatever that, say it's a 3% or 4% surrender fee on the money that you're taking out. So each product has its own surrender schedule. So depending on which product it is, it would, that's what the rate would be. So we'd have to look at a specific product for that. Next question we have here. Does the indexes have one but not both? I'm gonna say I'm thinking that question has to do with, do they have either the cap or the participation rate? Yes, most of the products probably, not all of them, but a lot of them, or a majority of them, have both either an index or a participation index option. So you could have one product that has, say, a cap of 10% on the S&P 500 and maybe a 80% participation rate on the S&P 500. So you could choose. You're not locked into that. You could change that after the segment. Usually the segments last either a year or 2 years, most commonly. But you can always change that allocation to whatever index segment. Some products may only offer caps, so it really depends on the product and what you're looking for. And that's where we help you kind of find exactly what makes the best option for your clients. It says, with the traditional fixed annuities, what is the rate guarantee period? It's going to depend. Like I said, there's a lot of different ones. When we looked at that annuity rate watch, you could see, you know, if you're talking about the surrender schedule, those are going to be probably, you know, anywhere between 5 or 20 years. If you're talking about guaranteed rates, most of the time the guaranteed rates, which is the fixed bucket option in your investments, those are right around 4%, but they change annually based on interest rates. But right now, most of them are somewhere around the 4% range on the fixed guaranteed bucket in the you know, fixed annuities. When you look at, you know, MIGAs or the fixed annuities of the world, like I said, right now, you know, a 5-year multi-year guaranteed annuity, you're going to be somewhere around that 5.5% each year for the next 5 years, based on where rates are. So, and I think that is all the questions that we did. I think I may have missed the typical commissions. I know we covered that. The good thing is, you know, commissions are paid as soon as that money is put into the annuity. And then depending on the carrier, some carriers pay weekly, some carriers pay bi-weekly. But in it, once you put the money in and the client, the product is approved, or the policy is approved, and they receive the funds, the next commission schedule based on that carrier, that's when the comp is paid directly from the carrier. All right. So that's all the questions we had. Again, I want to thank everyone for joining me today. Please feel free to reach out and ask any questions, see how we can help you. And everyone have a great day. Thanks.
Don't forget to subscribe to the latest news in insurance and agent training. See you in the next video.